Hello everyone. In this chapter we're going to be discussing flex budget variances. What exactly is a variance? Well, it's the difference between two different things. In this case, for a manufacturing firm, it's the difference between what you expected to have happen during a period when you set forth those numbers in a master budget at the beginning of the period versus what actually happened. And there's tons of different components of operations, and each one of those have their own variance. And when you go through and you analyze your variances, it allows you to do what they call management by exception. It is going through and seeing how far a certain component of your operations differed from what you expected to have happen. And then digging deeper and figuring out why. Can you improve this? Should we change the way that we budget for this? Doesn't matter really if it's good or bad. If it's a big exception, variance from what you expected to what actually happened, there has to be some better way to do it in an upcoming period, or there has to be at least some reason that that thing was there, and you have to predict, is this going to continue to happen? Because the purpose of budgeting isn't to exceed your budget to have substantially better numbers. You hope that happens, but it's to make an accurate prediction for your company so you can operate in a way that is efficient. What you're going to need to analyze your variances are those numbers you predicted in the beginning. And typically that comes from a static budget, which was a budget that was set for one particular level of output, production, sales, etc. And this, more often than not, is going to be your master budget. I'm willing to bet that, especially for a large company, the number of units that you plan on manufacturing and ultimately selling in your master budget is going to be different from the actual quantity of output that you had during the period. That makes it very hard to determine what caused your variance. When you had all of your numbers proposed, we're going to spend this much for materials, labor, etc. for one fixed amount of production, and your actual output was very different from that. So to get a better analysis of what went awry, what is different, you're going to need to create a flex budget. And essentially that is going to go through and is going to make an adjustment to those master budget amounts for your actual production level. It's basically augmenting the master budget to what it would have been had you known exactly what actual level of output you were going to need. So you're going to need your actual costs, your actual quantities during the period, what you produced, how much you paid for materials, labor, overhead, etc. for it. And then what you predicted in the beginning, the budgeted input you had for the quantity of output, how much you were expecting to pay for materials for each unit you made, how much you were expecting to pay for labor for each unit that you made, etc. I like to refer to the flex budget as the what should have been budget, because it tells you if you hit all of your standards in the beginning of the period, if you hit those numbers that you predicted for how much a pound of materials was going to cost, or how many hours it was going to take to make one unit of product X, if you hit all of those, well then your master budget, if you had known the level of output, would have been perfect. This is what should have been had we known we were going to make 1.5 million units or whatever. What types of variances can you find? What can cause a difference between what you're budgeted for originally, what your expectations were, and what actually happened? Well, a big one of that is sales volume. Obviously, if you produce less units to sell less units, you're going to spend less on materials. You're going to spend less on labor because there's less stuff going into making less units. So the sales volume variance is the difference that arises between what you set forth in the master budget and your static budget and what actually happened. They can be attributed purely to that difference in level of production and sales that you had, your sales volume. The flex budget variance is the everything else. And what else could cause a difference that you had there? Well, you could end up having to pay more or less for your inputs of production, for your materials or your labor, in terms of, wage prices, or in terms of the cost of a pound of plastic or metal. That would be a cost variance. It could take longer to make any one given unit than you thought was going to happen. That would be an efficiency variance. So a flexible budget variance is the difference between what should have been, given the standards that you set for production in the beginning of the period, and what actually happened. And those two together, the sales volume variance plus the flex budget variance, equal the static budget variance. What the difference between your actual result and your budgeted amount was, taking all things into consideration. In numbers, to make it a little more practical here, let's say we had a product and we budgeted originally to sell 2,000 units of that product. We also budgeted that each one of those units that we made was going to cost us $5 in material, and therefore to make those 2,000 units, which we were going to sell at $5 a piece, would have cost us a total in $10,000 in materials. What actually ended up happening is we made and sold 1,900 of these units, and it actually cost us $9,600. Well, if we took our standard, what we said on a per unit basis we should have spent on materials, that $5, and knew that we were going to make 1,900 units, well, 1,900 at $5 a piece is 9,500. That's the flex budget variance. It's adjusting your static budget if you had made it for your actual level of 1,900. If we had spent $5 per each unit in materials and we made 1,900, it should have cost $9,500. Well, the difference between what we predicted and what actually happened is $400. We spent $400 less in materials than we predicted. That should be good for us, right? Well, it could be. There's a lot of reasons that we had that $400 difference. And the big one right here is volume. We made 100 less units than we originally predicted. To make 100 less units, you spend less in materials. And if we made 100 less units and each one was going to cost $5, that means that $500 of this difference can be attributable to the fact that we spend less on materials when we make less production. Over here, our flex budget is saying we should have spent $9,500. We actually spent $9,600. We spent 100 more than we should have. That's not good for us. What can cause this? Either we end up paying more for each quantity of material, each pound, or etc., or we had to buy more materials to use in production than we anticipated. But regardless of that fact, we spent more actually than we should have. We have a $100 unfavorable variance. And if you think of that like a negative number, well, 500 savings here offset by $100 in increased costs here add together to our $400 favorable static budget variance. So favorable and unfavorable are the two words that are typically used to classify a variance. And people tend to look and want to find, okay, does actual above budget mean that it's got to be favorable? Does it mean that it's got to be unfavorable? It depends what element of your production you're talking about. If it's costs, the question, actually for all things, what you should be thinking about is what effect is it going to have on our income? And if it's costs, that means you spent more than you predicted. And if you spent more in costs, that had to lower your income. So actual costs being greater than budgeted costs results in an unfavorable variance. The inverse of that, if you spend less than you predicted, that should result in higher income. So actual costs being less than budgeted costs is favorable for your company. What about quantity? And we'll take labor, for example, right here. What happens if you have to take more hours to produce something than you predicted in your budget? It means you have to pay more to your laborers to work those extra hours. So if the actual quantity of an input being used is greater than you budgeted for, somewhere that had to cause an increase in costs, and that would be unfavorable for your company's profitability. If your workers, being efficient, productive people that they are, managed to get the job done way faster than you predicted, you had to pay them less hours, which paying less labor costs means they would have ultimately led to their productivity would have led to your company reporting a higher level of income. So actual quantity used being less than budgeted quantity used should result in a favorable variance because it's favorable for your profitability. So again, it looks right here like actual being greater than budgeted is always going to be unfavorable, and actual being less than budgeted is going to be favorable. Well, the only reason that's true for those two classifications is because they all relate to production costs. But what happens if you're talking about revenues? What if you actually had greater revenues, either by selling more units or by selling them at a higher price per unit than you expected? Well, actual revenues lead to higher income, so that has to be favorable. If your budgeted revenues are greater than your actual revenues, if you predicted you were going to have more revenue than you actually ended up having, that's not so good for your company's profitability. That's got to be unfavorable. So the difference between actual and budgeted is, if it's favorable or unfavorable, is entirely determined by what element of the company you're talking about. If it's something that increases income, actual being greater than budgeted has to be favorable. If it's something that increases cost, well, actual being above budgeted would always be unfavorable.